Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
The topic today is, do higher interest rates lead to lower home prices?
Okay,
so let's talk about conventional wisdom. Conventional wisdom says that if interest rates go up, that restricts the buyer pool, and because there's less people buying, that home prices fall.
Right. So the first thing I want to say is that this is not a seesaw thing where interest rates go up and house prices go down, or vice versa. That doesn't work.
Yeah, that doesn't work, and it doesn't work because of this this economic term we talk about, ceteris paribus. I know quite a bit about it. I have a master's degree, and with a focus on business and economics. And so, when interest rates are going up, there's usually a reason for it. They don't just go up on their own. And so what we did was we went and looked back over the last 4 times historically that interest rates went up by 2% or more, roughly.
Right. In less than a year.
In less than a year.
Or in about a year. Actually, these are anywhere between 11 months and 13 months, I think.
Yeah. Now, what's interesting about those numbers is almost never have interest rates gone up more than a year and 18 months, because they always go back down. Okay, because what happens is rising interest rates usually causes some Fed action. The Fed gets involved, starts pulling some levers, and then interest rates drop, right? Okay, so I'm going to go ahead and put the graph up. We'll talk about it, okay? Yes. So here's the thing. We have the title there, do higher mortgage rates lead to lower home prices. Now, this is the last 4 times that interest rates went up 2.5%. Of course, the current time is not included. Many of you know that interest rates have gone up now about 2%, right? And home prices look like they continue to go up. So let's go through these. The most previous time was April 99 to 2000. Now, you're probably asking yourself, hey, wait a minute, what about the housing crash? Housing crash here. Well, guess what? Interest rates were actually falling. They were even before the crash, they were falling. Interest rates were falling. They were 6.5, and they were falling down to 4 the whole time. And they were slowly falling while the market was crashing. So first, that's actually an opposite. The market was, interest rates are going down the market, because you would think if interest rates go down, people would, absorb all the inventory. Okay, but let's look at these. This was basically prior to the dot-com bubble. Which is the last time interest rates went up 2%, and the housing market went up 10.9%. The time before that was in the mid-90s. Interest rates went up to 9.2%, and home prices went up 1.2% nationally. Before that, back in the 80s, this was another time when the stock market had its, crash in 1987. Interest rates went up to 11.26%. Home prices went up 5.2% over this time. And then before that, in the 80s, now you see that number over there, 14.67%, okay? And real estate went up 6.6%.
So just to put this in perspective, mortgage rates at over 14%, and real estate appreciates at over 6%.
What's interesting that this doesn't show is just prior to this, interest rates went up. They at one point they were 17%, and guess what people were still doing?
They were buying homes.
They were buying houses, and there's a reason for that, and it's because it's, for many people, it's still a better deal to own a home. There's government incentives to own a home. You have to pay rent, and if your landlord has a high cost of acquisition, they pass that on to you.
Right.
So, most people are pretty smart. If they realize that rent's going to be X and buying a house is the same amount of money, or even a little more, they take the chance, they buy the house.
Right.
They want to acquire the house. So
remember, home ownership is more than just about money. It's also about stability. It's also about having some control in your life. It's about fixing your housing expense, because if you're getting a 30-year fixed mortgage, then you know what your housing expense will be going forward, and you're not hit with that rent increase on an annual basis. So there are a lot of other reasons to own a home besides just to own a home.
The only significant time that home prices have declined in the last 40 or 50 years was the last housing collapse. It actually caused the recession that happened after it.
Right.
So it was the housing collapse happened, and then 2 years into that, the Great Recession happened. So it wasn't like we went into a recession, it caused home prices to fall. And it wasn't because interest rates went up too high, because interest rates weren't too high.
No.
It was a completely different factor. It had nothing to do with interest rates. Interest rates had zero to do with it because, as we mentioned, interest rates were falling the whole time. Interest rates were dropping. Right. And as the Fed saw the economy getting worse, they were trying to drop interest rates to get the economy going. It didn't help. And the housing market was collapsing because of overbuilding and speculation. People were buying homes. They weren't able to sell them anymore. They defaulted on the loans. They went back to the bank. The bank listed them with agents. They put them in the market. They flooded all the markets. Phoenix at one time had over 60,000 houses. Miami had about, I think they had like 80,000 or something units. Like 80% of all high rises in Miami were vacant.
Right. But remember, that had to do with the lending practices at the time, which are no longer a factor
subprime.
Right, which are no longer a factor in the current market because lending has become much more rigorous as far as the standards are concerned. People have money in the game, so it's a whole different situation. Yes, we are dealing with inflation, but that also drives people into the housing market because they want to borrow at today's rates. So let's say, for example, that you're borrowing money today at 5.5%. If inflation is 8%, then you're good because you're making 3% on your money. So that's kind of baked in there, and that's part of the reason why you're seeing interest rates climb as far as what the banks are charging, is because they want to make sure that when you're paying back that loan, they're making money on that loan and they're not actually taking a loss on it. Because, like I said, if interest rates, if the interest rate that they're collecting from you is 5.5% and inflation is consistently 8%, they're losing money, and banks are not in business to lose money.
The other reason we wanted to show you this chart was to put some perspective on historical interest rates. We have gotten used to having like really ridiculously low interest rates. A lot of people took advantage of that and either bought a home or bought a few homes or they refinanced. I know people who refinanced like 2 or 3 times on the way down. Like they bought their house at 6.5, and then they refied at 5, then they refied at 4, then they refied at like 2.75, and they're like, why would they ever sell? They pay almost nothing for their house. It's appreciating in value, and these people that have these assets that there's no risk they can lose, they have a ton of equity. They're never gonna. Those houses are never coming on the market. So to some ways, those low interest rates made it possible for the existing market to do what it's doing, because people that are freaking out about 5% interest rates, oh my gosh, like this is historically literally never happened until probably 10 years ago.
Right.
Like you really, if you're buying a house around 2000, it was 8%, 8.5%.
Right. I've had a 13% mortgage before, so.
Yeah. So,
and I was delighted when I could refinance at 10. And I was even happier when I could refinance at 7 and change. And I was on cloud 9 when I was at 6 and change.
That was, yeah. So, anyway, certainly interest rates are going to they're cause and effect. It will probably knock some people out. Rising home prices probably is just as much of an effect on keeping people from buying, because that combined with rising interest rates, affect that. Remember, cash buyers don't care what interest rates are. They just look at the return they can get from. So if interest rates are going up but rents are going up, they don't care. They'll still go buy a house to turn it into a rental. Right.
So this impacts obviously people who need a mortgage. And so if you need a mortgage, so kind of give you a little bit of perspective. If you need a mortgage, sometimes you're better off biting the bullet and paying more for the house today, as opposed to down the road where maybe you might pay a little less for the house, but the interest rate goes up enough to where your mortgage payment on a lesser house is higher than that is on the more expensive house, because you got a better interest rate.
Yeah, and if you're buying for the long term, and we did this video probably a year ago, but the average person historically, like 20 years ago, only stayed in the house for 7 years.
Right.
And it's over 10 now.
It is over 10.
The average person stays in the house over 10 years. I believe that combined with the lack of building over the last decade is what's driving this housing market. It is a supply side problem. It is not a demand side problem, meaning it's not interest rates need to go up and choke off the number of people buying, because that's clearly, and we're going to watch this throughout the year. Here's the other thing too, is the market's pricing all this in, and just keep in mind that when the Fed, and when we get to the point where the economy starts slowing down substantially, and then the Fed doesn't want to crash the economy, so what they'll do is they'll start dropping the interest rates, and maybe they'll stop maybe they'll introduce quantitative easing, right? And they'll go out there and buy bonds back, and then put some money into the economy, right? And then that'll of course affect the 10-year housing, the 10-year Treasury bond, and of course that'll have a positive effect on interest rates coming down again.
Right. But remember, all of this takes time, okay?
Yep.
So this is kind of what we want to always impress is all of this takes a lot of time. The Fed just rose the Fed interest rate. However, mortgage rates started going up months ago. This is all, it all takes a while to kind of percolate through. So the interest rates went up before the Fed rose the federal funds rate. The interest rates went up before the inflation numbers came out. All of this was already kind of baked in. So this is kind of something to keep in mind. So the opposite's going to happen when the Fed goes to put more money back in the economy and the Fed goes to go ahead and buy bonds. You're not going to see those mortgage interest rates just drop. That will take time too. Part of it is because, it's a large economy and it takes time for things to percolate through. And part of it is because banks want to go ahead and pay themselves first, and then pass on any savings to the consumers down the road. Yeah.
Bottom line is the banks always win.
Yes.
The banks always win. And the reason why we did this video was because, there's people just, they just say, oh, interest rates are going up, that's going to, crash the housing market. Well, history that doesn't show that, because we've just shown the last 4 times that interest rates went up in a short period of time over 2%, and home prices went up.
Right.
So history is on the side of this. We'll of course track this. You can watch our other videos where we talked about what home prices are likely to do in the next year. Every single analyst, every single bank is predicting appreciation this year and appreciation next year, up to like 15%, 11 to 15% this year, 3 to 5% next year. Every single one, even the naysayers are predicting that home prices will go up, and they can all see what's happening with interest rates, and they're looking, they look at historical data too to build these models to decide. And so anyway, please.
So absolutely. So while they are predicting all as far as continued housing appreciation, remember, real estate is hyper-local. So talk to your real estate professional in your market to find out what's happening in your particular market, because these are national numbers that we're talking about. So your market may end up doing 23% in appreciation, or your market may end up doing 2% in appreciation. These are national numbers that are kind of put together.
We did a video a few weeks ago where we talked about like the worst markets, and Los Angeles was one of them. But it depends where you are in Los Angeles.
Right.
There's some markets, parts of Los Angeles, which is, that are doing very well, and some that are not doing very well.
Right. So Las Vegas is a much smaller market than Los Angeles, and it's kind of fun to always look at our appreciation map. The title companies put those out, and they put them out by zip code, and it's wild, because you'll have anything from a couple points in appreciation all the way to 20 something in appreciation, or you'll have zip codes that are actually depreciating, and you'll have zip codes that are massively appreciating, because real estate is hyperlocal.
Yep. All right. If you liked the video, please share it with your friends, subscribe, notification bell, and leave us your comments.
Yes.
And tell us what you think and why you think interest rates are going to affect or not affect it, especially those of you who have gray hair like me and you've lived through these, maybe you bought your first house like I did in the 1980s, bought a house in the 1980s with a VA loan when I was on active duty in the Marine Corps, and my mortgage payment was $555 a month.
Nice.
But market rents in my market were like $500 or $550 because I remember I got transferred. We transferred duty station, and I rented out the house for $550 a month, and I had a $555 monthly payment. So it was a pretty good deal. I was like, I own a house, it's appreciating, the tenant's covering my, and interest rates were certainly a lot more than 5.5%.
Right.
A lot more than 5.5% back then.
Yep.
All
So
right.
like the video, subscribe, hit the notification bell, leave us comments. Always leave us comments, please. And we'll see you on the next video. Bye.
Bye.